Good afternoon, everyone. Welcome and thanks for joining today's conversation, all about how to avoid Payday Super penalties. Remembering, Payday Super is now legislated and due to come into effect on the 1st of July this year. Now, my name is Ruth Weaver, and joining me today is James Barry, one of our resident experts here at ART about payday and all things penalties. Now, James is currently the risk manager for our own internal Payday Super project. He has worked with superannuation for over 12 years, including a couple of years at the ATO, working on superannuation reform policy. So I can't think of a better, more versed voice to have with me here on the couch today. Thank you so much for joining today, James.
Thanks for having me, Ruth.
Now, a little bit of housekeeping before we get started. Firstly, thank you so much for all of the brilliant questions that you sent through to the team. James and myself and the team here have spent a lot of time over the last week or so looking through those questions, and we're pretty confident that the very vast majority of those questions will be covered in the content today. Now, we've also kept the Q&A option open on the live event, so please do take advantage of the Q&A. We've got the team here with us who are manning that. We have advertised as a 45-minute session. I'll ask for your forgiveness in advance if we go a little bit over that, but that will be because of the Q&A at the end, and we want to make sure we can address as many of your questions as possible. Also, while we're still on the housekeeping, I do want to remind everybody that we have a very broad range of employers with us here today, ranging from quite small rural regional employers to big corporate institutional clients, as well as, of course, as our government departments. So when James is answering the questions, because I get the easy job today of asking, when James is answering those questions, please just bear that in mind, that it is a very broad answer and very general in nature. We don't know your own businesses or the circumstances attached to it. Now, I know that many of you joining today will be quite well versed on Payday Super and the legislation, but James, for those who might be new to the conversation, let's just go back to the beginning and give our audience a very quick recap on what Payday Super is and why we are seeing this come into effect.
Of course. So Payday Super, I think everyone knows the headline. From 1 July 26, employers have to pay their super at the same time as their salary and wages. Now, this is a huge change, probably the biggest change we've had across super since it was introduced in 1992. So to break it down, we really see there's 5 main categories of change that Payday Super is going to implement. The first one is really going to impact employers. Employers have to ensure that their employees' SG is received by their super fund within 7 business days of payday. There's also big changes for super funds. They're going to have to change how they allocate and refund those contributions to make it much faster. There's going to be a full revised penalty framework called the SG charge framework to handle the change to Payday Super. There is a new revised data and payment standard, so that's updates to SuperStream, how clearinghouses and super funds and employers all talk, as well as the implementation of mandating the new payment platform, so funds can receive payments via a real-time payment platform. And finally, onboarding rules. 7 business days isn't that long of time for an employer to pay an employee's super, especially when they're brand new. So there are some extra rules about new employees that will actually give you 20 business days after payday to pay those new employees.
Thanks, James. Now, one of the questions we saw come through quite a lot in the pre-submitted questions at least was around the SGC, or the superannuation guaranteed charge, and how the framework there is changing. So what is the purpose of changing the SGC for employers?
It's all about aligning the SGC, which is the tax you pay when you don't pay your employees in full and on time, with the requirement for employers to pay on payday. So the SG charge framework is introduced to make sure workers are put in the same position. They're not worse off because an employer didn't pay in full or on time. It also is meant to incentivize employers that if they do pay late, they quickly make sure they pay that employer and they come forward to the ATO and make a voluntary disclosure. And finally, there is a new scaling up of consequences so that if employers who don't do the right thing, they're going to get hit by a higher SG charge framework and potentially higher penalties afterwards too. So when does the SGC really come into play? It automatically applies when an employer does not pay in full and on time. It can also apply when an employer does not follow their choice of fund obligations. So if an employee's made a a valid super fund choice and the employer doesn't pay to that fund within 2 months, then they may also be liable for the SG charge. Now, the biggest change to this SGC trigger is that previously employers were mandated that they must lodge an SG charge statement at the end of each quarter if they had any SG charge liability. Under Payday Super changes in this new framework, however, there is no mandatory lodgement of an SG charge statement. This means the big call out to employers is, until you get assessed SGC by the ATO, if you've identified you've underpaid an employee, you should make sure you try and pay that employee to their super fund as soon as possible. So what is the new SG charge? It is a tax. It's a tax that's assessed by the ATO and recovered, and it has 4 components at a high level. Firstly, we've got the individual final SG shortfall. This is the amount of SG that remains unpaid after on-time and late contributions are taken into account. We then have notional earnings. This is meant to make up for lost investment earnings. It's a daily compounding rate on the SG shortfall, and that is going to be calculated based on the general interest charge rate daily. There is also an administrative uplift. This is the one that we are still waiting to hear a little bit more from the ATO and Treasury about how it will work. But the idea of the uplift is that it's an additional charge, up to 60%, that may be reduced under specific circumstances. Now, it's those circumstances we're waiting to hear from the ATO. When it was released for consultation in March 2025, the instances where reductions were going to be considered is where an employer came forward and made a voluntary disclosure to the ATO, and where there was no previous history of that employer having a default assessment from the ATO. And then finally, the 4th component is choice loading. So this is where an employer has failed to meet those choice of fund obligations. The employer will be liable up to 25% of the amount that they paid to the non-choice fund. There is a capping of this. It's limited to $1,200 per notice period.
Now, that's a lot to digest in a short period of time. I will first, before I come to the next question, remind our audience that we are recording today, as we always do with these events. So if you do want to go back and sort of listen to that again and sort of really digest it, you'll have the opportunity to do that, and we'll get our recording out to everybody within the next 24 hours, hopefully, as well. So it is nice to understand, I suppose, the penalties. Hopefully we never have to really pay them, but what would actually happen? So what would it mean in everyday terms for an employer, notwithstanding how the penalty is calculated? What does the process, or what would happen if, for example, you were making a late payment or you had underpaid an employee?
Yes, well, it is going to be very different to today. So as I mentioned before, in today's world, if you identify you have paid late or underpaid for a quarter, your step is that you must lodge an SG charge statement with the ATO. That is no longer required under Payday Super. The lodgement and a notification of the ATO of an underpaid amount is now a voluntary disclosure, which employers should still be encouraged to do because we expect it will reduce that administrative uplift and therefore reduce the total amount of SG charge that the employer is going to be liable for. The ATO is also now going to be the one to calculate the SGC instead of using the SGC statement that is lodged by the employer. How they're going to do this is using the single touch payroll data that they receive, as well as the super fund data. However, there is also the ability for an employer to lodge a voluntary disclosure. We're still waiting to hear from the ATO about how that process will actually work. But where an employer comes forward with a voluntary disclosure to the ATO, providing the employees when they were paid, how much they were paid and when, the ATO is going to use that information to raise the assessment, and the likelihood is that you'll have a lower administrative uplift applied when that SG charge is calculated. Now, one thing to be very wary of is the SG charge assessment is going to be made on the day that the notice is served on you, and that notice is going to become due and payable on that date. There is no 28 days after the assessment is created like we have for income tax. For SG charge, it will be liable on the date that it is raised. And that means general interest charge will start accruing from that date. So the big call out to employers is that until you get an SG charge assessment from the ATO, the first thing you should do is pay any late contributions straight to your employee's fund. Then you should have a look at, do I need to make a voluntary disclosure to the ATO to limit how much SG charge assessment may be raised against you? And when an assessment is raised, make sure you make that payment to the ATO as soon as possible.
I remember when stapling, and I'm sure that most of our audience here today will remember stapling, we thought that was the biggest shift that we had. And at the time it was, I suppose, one of the biggest changes we'd seen in superannuation. I think this challenges the magnitude of the change. Payday certainly gives it a run for its money with regards to the size of this change and the way it's going to impact employers. But one of the things that stands out with stapling that I can particularly recall is that there was a little bit of a soft launch and a phased approach to it. There was some leniency, some grace periods that employers enjoyed, particularly smaller employers were given a little bit of a longer window to adapt to stapling. Is there any plans, James, or do you know of any sort of transition stages or leniency, I guess, that might be somewhat allowable in that first 12 months perhaps?
So when we look at the actual legislation, no. It is a hard start date. So all paydays for employees that are employees for SG purposes, they will have to have their SG paid within 7 business days from 1 July 2026. However, what the ATO has come out with is something called a practical compliance guideline. Now, this is a guideline that sets out the factors they are going to consider when they are working out how to direct their compliance resources. And they have said for the first full financial year of Payday Super, they are going to use a risk matrix and put employers into a low, medium and high risk categories based on their activities. And the real call out here is you want to be in the low risk category. The ATO will not direct compliance resources to investigating employers who fall into this category. Now, I encourage everyone to go read and apply it to your own circumstances, but at a high level, how do you stay in that low risk category? You need to start paying super on payday from 1 July 2026. If contributions get refunded back to you, or there's other circumstances outside your control that mean that your contribution was received late or you undercalculated, as soon as you identify there is a problem, you should act to try and rectify that. If you don't move to Payday Super from 1 July, or you don't act quickly when a contribution is refunded back to you, the likelihood is that you may fall into the medium or high risk category, and the ATO might start using their compliance resources to engage you. Now, probably one caveat here is that this is just how the ATO is going to use their compliance resources. The ATO is still required, if they identify an SG shortfall, they must raise an assessment. And so if there is any underpayment or late payment you identify, don't accept that I'm in a low risk category, the ATO won't come after me. The best thing is to get the money into the employee's account as soon as possible.
That's good. It's good to know that, because it has been a source of quite a few of the questions, yes, of the hundreds of questions that you pre-submitted for us. A lot of you were asking in different ways around that, whether or not there would be some sort of leniency. So it is great to know that. Now, another type of question that we saw a lot through those pre-submitted ones was around, well, we know the SGC framework is changing, we understand our obligations, but is there any extra penalties going to be associated with Payday? I know you're all hoping the answer here is no, but...
It's already on the screen, it's yes. So everything we've talked about so far with the SG charge, that is actually a tax, not necessarily a penalty. There is, however, a new regime being introduced, and it is called a late payment penalty. Now, we need to separate this from late payment to a super fund. This is about late payment of an assessed SGC amount to the ATO. So when the ATO raises an assessment of SG charge against an employer, it's going to become due and payable on the date that the notice is served on that employer. 28 days will elapse, and if there is any amount of that SG charge assessment remaining unpaid, then the ATO is going to be required to issue what is called a late payment penalty notice on that employer. That notice is going to list an amount that the ATO is requiring the employer pay and a date that they must do it by. If the employer doesn't do that within the 28-day window that the ATO is going to provide, then they will become liable to the late payment penalty. And the penalty is going to be equal to 25% of the late payment amount. If an employer becomes liable for this penalty twice within a 24-month period, then it becomes a 50% penalty. And so the big call out here is, if the ATO assesses you for SGC, the first action you should do is make sure you pay the ATO. Otherwise, you might find that your penalty and the taxes you're going to pay to the ATO are significantly higher.
Yeah, it is definitely something I think that a lot of employers are incredibly mindful of, and I think there's certainly an incentive there for employers to really get their ducks lined up and to get themselves ready and prepared for payday. So on that, it sounds like, you know, the stakes are high here. We want our employers to never have to worry about penalties. If that's the case, what could an employer be doing now to get themselves ready? And look, we do have a lot of employers who in some ways are probably very close to already meeting Payday Super requirements. I think the key here though is just because you're paying at the same frequency, as in, you know, we pay salaries on a fortnightly basis, we're also paying super on a fortnightly basis. Is it within that time period though? So we just have to be very mindful. What can an employer start doing today to get themselves ready so when 1 July comes, it's not a shock to the system or a shock to the organisation?
Yes, it's all about preparing your people and preparing your processes. So starting with our people, it's a big awareness piece. A lot of people would have seen the news articles saying you got to pay super on payday. That's not actually the legislation. It says that the money must arrive in the bank account within 7 business days. And so there is a high level awareness from people across the business, but the people who actually really understand it, it really seems to be payroll. So the first piece should be make sure everyone across your business is aware of how Payday Super is going to impact you and your business. You then need to work out who is responsible, who is going to have clear roles and responsibilities. As I mentioned, there's calls to action if you identify that you paid super late, making sure you pay the employees super as soon as you can. If you identify you become liable for the SG charge, how are you going to raise this with the ATO via a voluntary disclosure? Who is going to be accountable and responsible for those pieces? Because you don't want to think someone else is in your business, wait 28 days and you get hit by a penalty. And finally, training. There is a lot of change across super for Payday Super. It's probably the biggest change, as I mentioned before, since 1992 in the super industry. And so you need to make sure all of your staff and your payroll are aware of the impact. Do you need to implement any training programs to make sure people are ready by 1 July? Because that is the ATO's expectation. They've put out that guideline that people in a low risk category will not have compliance resources applied to them. And to be in that category, you need to be ready and have those processes in place and be paying on payday from 1 July.
So that's the people side of things. There's also a lot of process preparedness that you can start thinking about as well. And so there's a lot you can be doing.
Yes, there's a lot of processes. A lot of them come down to the actual super contribution process, checking your data. A lot of super funds today, they have 20 business days to refund a contribution when it comes through and there is an error and it can't be allocated. And a lot of super funds spend that time trying to contact the employer and correct it. Under Payday Super, you don't have that time. If a super fund sits on money for 20 days trying to work out who this member is, the employer is going to become liable for the SG charge. And so the biggest change you can make is reviewing your data, the employees' data, their super funds. Are you receiving any warnings from your clearinghouse today? It still lets you submit, but you should make sure you check those warnings because from payday, super funds might change the way they accept data and what is mandatory. So check with your super fund, with your clearinghouse, with your payroll provider. Are there any changes to the data you need to send through? And do you need to do any governance and cleanup on the data you hold within your payroll systems?
Yeah, dirty data is probably going to be your biggest challenge, isn't it? To really clean up the data, and you're less likely to face any.
Exactly.
Yeah.
I think probably the biggest question we get is under Payday Super for small businesses is how they're going to manage their cash flow as well. And so you need to start thinking, today I can wait till the end of the quarter to pay my liability. How is my cash flow going to manage if I need to make that payment every fortnight or wherever your pay cycle currently works? You also need to ensure you've got the governance in place. So who is looking at payroll to make sure that they are moving to the new super base? So currently today employers pay 12% of ordinary time earnings. Payday Super introduces a new base that employers pay super on. They're now going to pay it on qualifying earnings. So do you have someone who is going through in the background and confirming that you're paying on qualifying earnings and there's no extra changes that are impacting your payroll? And finally, look at your process of onboarding employees. We talked about dirty data. The biggest driver of dirty data is employees providing their super fund choice to their employer, and it includes the wrong USI. Maybe it's got a unique student identifier instead of super fund identifier. Maybe they've put their unmarried name. There is sometimes that data that is going to cause problems with the super fund. And so make sure you have better governance processes in place when you're getting that data from your employee to check it up front. And consider trying to use the new member verification request interaction in SuperStream, which will be built into a lot of your payroll and clearinghouses. That lets you confirm when an employee gives you their super fund choice details. It lets you check with that fund if the details are correct and if they'll accept a contribution before you actually send that money. And that's going to be introduced by a lot of clearinghouses and payroll providers between July 26 and March 2027.
And that will be a game changer to really sort of put a bit of a pin in a lot of that, I suppose, that delay that can happen between the employer and the fund getting that information back. Yeah, that seems like a lot of work for the employers. And look, generally when we do see these legislation changes come into effect, I always say when I'm talking to employers that a lot of that hard work does land at the doorstep of the employer to implement. If we think about stapling, a lot of the responsibility fell to the employer. What can the funds be doing, and what is ART specifically doing to help our employers meet these obligations? Because it's really not just impacting the employers themselves. There's a huge uplift required across the industry and across the super funds to facilitate employers to actually meet these obligations. So can you just comment a little bit on, you're well versed to comment on this, given you are knee deep in this project, but what are we doing internally here to help our employers?
Well, Payday Super is going to make the number of contributions being made to super funds explode. Probably around 4 times depending on what your fund is and what the employers are doing. And so there is a lot of work that needs to happen to make sure these funds can handle that increase in transactions and that we can remain online and get back to employers straight away and making sure that we are helping them meet their 7 business day timeframe. So some of the things that ART is doing is that we're looking at trying to put more upfront validation. If we receive contributions that has data that we know we're wrong, we're probably going to be rejecting that back to the employer. And so that's why it's an extra call out that you should double check, are you receiving warnings from your clearinghouse from contributions today? Because after 1 July, those might become rejections because it's missing mandatory data that the super fund needs. There's also a lot of work that we're doing behind the scenes to update to SuperStream. So SuperStream is the way that super funds, employers, clearinghouses communicate the data side of the contributions separate to the money. Yeah. The ATO is introducing a new SuperStream standard called Contributions version 3. And so we're going to see a few things coming through that. We're going to see improved error messaging, that new member verification request interaction that I mentioned, but it also is a total change to the way that these clearinghouses work. And so one of the big things we're doing is that we are going to be moving employers who use our Employer Online platform today to our new Beam Online platform. It is going to be payday ready. It's going to be fully compliant with our SuperStream Contributions version 3 standard. And we're going to be coming out to employers who are current users of our Employer Online over the coming months with more information about how that is going to impact you. And I expect a lot of funds across the industry are going to take similar actions. This is really a complete transformation of super. And so the way you do things today will change from 1 July. And we'll be communicating with you about all of those changes.
I hope there's some comfort with the audience here today, our employers who understand that we do realise, and we are certainly aware of the task at force that is landing on your doorstep. But I do want you to know that we've had a huge team here at ART for quite some time now, working really hard. James is knee deep in that team, working really hard on our end as well to make sure that we have the right tools for you to help you meet these obligations. So before we go to Q&A, and I have my phone here, I can feel it buzzing, so there's obviously questions coming through, but before we do that, I will just wrap up on some sort of more housekeeping things. Just to remind everybody, again, I think it's pretty evident from what James was saying, don't wait until 1 July to start getting ready for this or thinking about this. You can be practicing meeting Payday Super requirements now, and as I said, there are actually employers out there who, whether it's accidentally on purpose, are actually already meeting the requirements, but just being mindful of the timeframes, or you might be meeting the requirements for the majority of the part, but is your data actually clean? Is your fund doing a lot of hard work on the other end to clean up some of that data that you won't have that timeline after 1 July? Check in as well with your payroll provider, with your bank and your clearinghouse as to their preparedness and their readiness to support you to meet those obligations, and stay informed. The conversation has been live for a long time. It's probably relatively new with the employers, but it has been happening in the back end for quite some time. You're probably feeling like you've been knee deep in this for ages. But the ATO is always bringing out new information, always clarifying certain points. So just keep an eye on the ATO website in particular, because that is constantly being updated. We're also updating our own web page that we've dedicated for this whole topic, payday. And if we learn anything or anything new comes to light, we'll absolutely be posting it on that page, including a recording of today, James. Will land on that page. So any extra information or new information we put onto the art.com.au/payday super page, which you can see here. So keep an eye on your employer hub. There's lots of FAQ documents on there. In actual fact, a lot of the frequently asked questions that are on that document came from the last webinar that we hosted, and from the questions that you're putting through to your relationship managers or to your contacts at ART, or when you call and ask a question. We're using real questions that are coming through to populate that, and we'll go back and look at what came through today as well to see what do we need to update, where are the pain points or those sore points for employers, where is the interest in the information that's missing. Quarterly newsletters, we're always sending out those to you. You're getting personalised emails, general emails, as James said, as we're maturing that move over from EOL or Employer Online. We'll be bringing lots more information to you about the uplifts there in how you're paying superannuation. That will all come to you in due course throughout the year, so keep an eye out for that. So we've been quite good on timing. So we were hoping we'd get here by 1/2 the hour. So we are there, and we're going to go to questions now. I do have a couple that I plucked out directly from the pre-submitted questions intentionally. Some of them were my favourite questions, but I also thought they might be quite useful questions to put to James for the benefit of the audience. So you keep your questions coming through now, because we have this time allocated for the live questions as well. But if I could get started on a question around the payroll providers. We saw a lot of them come through on this. So it's one thing for the employers to do the right thing, and it's one thing for the super funds to be ready to accept the money, but how prepared are the payroll partners? And how involved have you been with learning about their preparedness?
We've been heavily involved. The payroll providers have been part of the conversation since the start, because there is a big change to them. So I did mention before the change from ordinary time earnings to qualifying earnings. And the ATO is going to use the single touch payroll data to raise their assessment. So that means the single touch payroll is actually going to be updated to start reporting this new qualifying earnings amount. Now the ATO has said this is going to be mandatory from 1 July 2026. We're expecting all payroll providers to be ready to start supporting employers to report by that date. From what I've seen, most of them are working around the clock to be ready for that date. Individually, we'll have to talk to each payroll provider to see where they are. So the call out to you is talk to your payroll provider. Find out where they are, when they're going to be releasing their new single touch payroll reporting, and what you need to do to be ready, because you'll need to make some changes on your end to work out how you're going to report this new qualifying earnings amount with your single touch payroll every payday, on top of you making your payments to the super fund.
Yeah. And another really common question that we saw coming through was around what would happen in an instance where you've identified that perhaps you were underpaying employees, or you didn't pay employees their full entitlements, for example, and it came to light, or it's a late payment. What would happen in the case that you've got to go back and make salary payments in retrospect? Does Payday Super
impact that?
Or
the good news is that your SGC liability is accrued on a cash basis, meaning when you actually make your payday and you make your payment to the employee, that's the day that your 7 business day usual period for paying super will commence. So if you have a back payment, it relates to work that happened 2 years ago, but you pay it in September 2026, the payday in September 2026 will be day 0 of your 7 business day count. So it's good news for those back payments. There's still obviously a lot of other problems with back payments, but for super, the day you actually make the payment to the employee is the important date for Payday Super.
Yeah, that's good to clarify. There was another question I recall seeing. If you're an organisation that has a shutdown period, for example, during Christmas, is there any leniency or any sort of exceptions you can apply for things like that?
Yes, so people who have been involved in this Payday Super conversation for a while will know that there was a big change in about October last year with the government's position on Payday Super. So when it was first released for consultation in March 2025, we were dealing with a 7 calendar day timeframe. And people were very worried about Easter, about Christmas, about shutdown periods, how to meet a 7 calendar day window. So the government did come to the party and did change that it's now a 7 business day window. But that is really the only concession.
Yeah.
So as I mentioned before, your liability is accrued when you make your payday payments. You need to consider around Christmas, do you need to change your processes? But there is no special shutdown provisions or any extra time that you get during those periods. It's still 7 business days from your regular payday.
Okay, so maybe to expand on that, is there a scenario where an organisation who wants to be super organised, no pun intended on the word super organised, and wants to actually make some payments in advance? I know it's probably not very common, we wouldn't really see it too often, but is that something you think?
Yes, you'd be surprised how many people do this
Do
by
they?
accident or by on purpose, but there is carry forward provisions. So you can take into account a super payment up to 12 months in the future.
In advance, okay.
So you can make your payments up to 12 months ahead of the actual payday.
That's really good to know. Now, I have a few coming through. I don't know whether to wear my glasses or not. I need bifocals. I don't have them, so excuse me. I've got a question from Charmaine. Our current process for rejected super is for us to wait until the funds are returned to us prior to redirecting the payment. Will this cause potential issues with meeting the deadlines? And will the refunds become a faster process?
So that'll be very dependent on your circumstance, but yes, we expect a lot of the payments will be faster. It really depends about who your payment is coming from. Do you use a clearinghouse? Is it direct to fund? And what is the process for that fund or clearinghouse to refund to you? So there are going to have to be changes. You're going to have to make sure that you follow that existing process, that your contribution rejection comes back, you wait for the money to clear, and then you redirect it. The ATO's practical compliance guideline does talk about this specific scenario. And so you need to have a good review of that. And the big call out is as soon as you can act, make sure you act and you'll still fall into that low risk category.
Yeah. There's another question. Is the Art Super Clearinghouse an alternative to the ATO's Small Business Super Clearinghouse? We actually didn't mention the fact that
We didn't.
Yeah.
So yes, the ATO has a Small Business Super Clearinghouse. It is currently running. It's closed to new registrants, and it is going to close entirely from 1 July 2026.
1 July, okay.
1 July. So there is a lot of employers out there. It's mostly small businesses. You've got to have a certain number of employees and a certain turnover to use it, who are going to have to find a new provider. And my call out would be don't wait till 30 June to try and find that provider. Yes, Art Clearinghouse is available for employers who want to come and use it. The big problem with the ATO Small Business Super Clearinghouse closing at that date is the last quarter for 2025 isn't due until 28th of July. And so I'd be worried if I'm an employer who's expecting to use that clearinghouse, I get to the 28th of July and it's gone, I can't use it. And now I'm quickly running around trying to make my payments and I'm probably going to become liable for the SG charge. So don't wait until 30 June, look for an alternative provider and check out our website, which has got information about about Arts Clearinghouse.
Arts Clearinghouse, yeah. There's a great question as well about what happens for the June quarter this year. Do we have until the 28th of July to pay the quarter this year, or are we do we have to go retrospect back?
No, so the way the Payday Super is going to work is about the payment date. So if you're paying your employees on 30th of June, that is part of the last quarter, and that last quarter it must be received by the super fund by the 28th of July.
Okay.
If you then make another regular payment on 1 July 2026, it's under the payday rules.
Okay.
So you'll see sometimes the quarterly payment will be due after the first payday payment. So you need to be aware of that.
That's a really good point. Where I was, a sort of an add-on to that is more from a member lens. So there isn't a change to the quarterly payments. That will only really come into effect from 1 July. So the 28th of July, it's really good to know that the quarter can still be paid as late as the 28th of July to meet obligations. But if you've got employees who might be high enough income earners, I would say just being mindful of the concessional limits that are there, because if you've got an employee who might be hovering close to the concessional limit, and an employer contribution, generally will get taxed at 15% on the way into super, and there is a limit to that on how much can apply that concessional tax. So it is really important that employees are also aware of Payday Super and the implications it might have on them personally.
Yes.
It is a good thing for members. We know members are ultimately going to be better off. The money is in their account sooner. They are earning returns on it sooner. But it's just being mindful, particularly for the next financial year, that if you are having a quarterly payment made in July and then you're changing to weekly or fortnightly payments, you might find for that calendar year you have a little bit more going into your account, which could push you over that concessional contribution cap, which is currently 30,000. So it's just as an employer as well, being mindful that your employees are getting access to the information, you know, if they're encouraging them to understand what it means from their perspective as well.
That's right. And there's probably the extra part of that is there's two issues there. There is the concessional contribution cap, which you mentioned, high income earner who's receiving essentially 5 quarters of super payments. And that might have been capped due to the maximum contribution base. How those apply are two separate things. Employers need to be aware of the maximum contribution base, which is per financial year, the actual amount of ordinary time earnings or qualifying earnings that you pay within that financial year. Under Payday Super will be an annual limit. I believe it's up to $250,000. So once you've paid $250,000 in qualifying earnings, you're no longer required to pay SG on qualifying earnings above that amount for the rest of that financial year. And so for that maximum contribution base with employers, it's all about when you're making that payment to the employee. For the employee, the member, on the contribution cap, it's all about when the super fund receives it. So both are impacted. They both have different sort of tests and when they apply. So you need to make sure you're aware of what you're doing, and potentially should you consider thinking about when you make your final Q4 of 2025 payment to avoid those unexpected consequences occurring.
It is when you get into the weeds of these things you start to actually unravel that there can be, you know, different types of consequences that we never really even thought of until we sort of delve in a little bit more deeper. There is a question, James, does the 7 days rule include the clearinghouse time frame?
It does. So what the legislation has come out saying is that it is a due date model, which is the same as it was in the quarterly period. What matters is when the money is received in the super fund account and can eventually be allocated. But when it first hits the super fund bank account, that is when the employer has met their obligations. So clearinghouses in the middle, they are a part of that employer's 7 business day time frame. So don't wait until day 6 to make your payment. That is why Payday Super is talking about making your super payment on the same day as your salary and wages. You should do that because there are the clearinghouses in the middle who need some time to be able to match that contribution and pay it on to the correct super fund.
That's a good tip. If an employee changes their super fund and doesn't notify the employer, and we know that that happens, it's probably the bane of a lot of payroll existence. It is a frustration point, we do know that. So if someone changes their fund, doesn't tell the employer, and the contribution is returned then by the original super fund, will the employer still be liable for the SGC or the super guarantee charge?
So in this case, this is where the employer will actually be given more than the usual period. So the usual period is the 7 business days. There is exceptions where an employer gets more time. And so this is one of the scenarios where the employer will get more time. They'll get 20 business days starting from the day after the payday. So if there is a new employee or if there is a change in that employee's super fund, that's when the 20 business day timeframe will come into effect.
So effectively, it's a little bit like the new employees with the onboarding. Those rules will apply for anyone who does change
their super fund. That's right.
Their super fund. And how would an employer notify the ATO of that? Or is there, you think in theory that sounds good, I've got that extra time, but if you've identified that then, how do you stop the ATO thinking, is there something you can do as an employer in advance to prevent?
No, not that we've seen from the ATO come out at the moment. Those are sort of the more detailed scenarios that we're expecting to see between now and 1 July come out. So I'd probably say keep your eye on the ATO website and the ART website about those sort of more detailed scenarios.
And the other thing to remember is this is not our last Payday Super webinar. We might bring you back for round 2, given the amount of questions that are coming through. And as James said, we are still getting clarity on some of those finer details as well that are coming through. And when we know, you'll know. One last one, James. We are nearly at time, but I wouldn't mind putting another one to you. This is a good one. Does Payday SG timeframes apply to subcontractors as well?
So that is a very detailed question. It'll come down to the specific scenario. But
just
at a high
level,
you need to work out, is that employee an employee for SG purposes?
Yeah.
So there are contractors who are considered employees. It all comes down to some tests about whether they're mostly being engaged for their labour. So you'll need to look at that specific employee to work out. There is no change between quarterly and payday about who is an employee. So there shouldn't be a change from today to next year, but definitely this is part of those people and processes things you need to do before 1 July is double check. If they are an employee for SG purposes, then yes. The date that you make the payment to them, whether that's the general salary and wages, or if you're paying an invoice for a contractor who was an employee for SG purposes, the day you pay that invoice will be payday for that 7-day window.
Yeah. Now, I know there's still questions coming through, and I know the team are responding to a lot of those more particular technical questions with written responses. But what I would say, James, before we wrap up, we are just on a Q2, is maybe just some final tips or tricks that you might suggest for an employer today who's engaging in this for the very first time. What would be the 1 or 2 top items you'd say, look, these are your absolute necessaries now, and then work on it from there?
Number 1 is data. Go check your data, see what is coming back from the clearinghouses. Just because the clearinghouse or super fund has accepted your contribution doesn't mean they haven't come back and said, hey, there's this little data piece that's missing that would be better if you send through. Because from 1 July, that might become mandatory. So you need to make sure you provide those. Number 2 is making sure your people and processes are in place. So who is responsible and who is accountable, and what governance processes do you have in place to pay your super, identify if you've done it properly, and then quickly voluntarily disclose to the ATO and make your payments if things do go wrong.
So I think the data was one of the areas that came out in real strength in the last session that we did. There was a huge amount of questions around, particularly onboarding. So I think you can link the data with your onboarding, that if you can have a really strong, diligent onboarding process, you're not likely to come across issues or dirty data, as we say, and then have the flow-on effects that will have on you. So.
That's right.
Yes, look at your existing data and your existing notifications that might be telling you you've got concerns, but really think about onboarding. So is there any sort of last tips around that particular process? Because if you get it right at the start, then that'll follow you through that whole journey with that particular employee.
Just review your process of how you actually obtain that information. Probably one thing to call out is there is an ad ban that's also coming in. So the way that super funds currently advertise to employees during that onboarding phase is going to be something that's banned in certain circumstances as well. So there might be changes to the tools that you use to obtain that super fund choice from your employee. There might be changes to when you can actually use the stapling fund process. So I think most employers should do a full review of that whole onboarding process, work out how they're getting that information from the employee, and maybe considering moving to a digital platform to obtain that information where you can validate it up front. I did mention the member verification request before. That is the big call out. You can't do that before 1 July, and it's going to be implemented across the industry over a window between 1 July 26 and March 2027. Once that's up and running, that means employers who receive that choice can check it with that super fund. So make sure you're actually doing that. It is going to be mandatory, but it's actually in the employer's interest to do it, because it means you identify the dirty data before you're trying to do your super, not halfway through your 7 business day window.
I'm going to leave it at that because I know we have thrown an awful lot at you. Just to wrap up, I will remind everyone that we're sending the recording of this particular session out. We'd love to get that out this afternoon. Please do bear with us, though. It's very likely going to be tomorrow before we can get that out. We will also place that on the art.com.au/Payday Super on that particular webpage. So if you do need to go back and listen to the words of wisdom that have come through James today, you'll be able to go back and pick which section you really want to delve into a bit more detail on. We will be back before Payday Super comes into effect with another conversation on Payday Super, and we won't leave the conversation on 1 July. We will be doing check-ins with you all after 1 July as well, just as a little bit of a check-in to see how things are going and to continue to answer your questions on this topic. On behalf of everybody here at ART, thank you so much for taking the time to join us. Thank you for taking the time to watch back on demand, if that's what you're doing. James, thank you so much. I know how in demand you are at the moment and how busy you are with this project. I can't think of a safer pair of hands to be looking after this from our perspective here at ART. We'll get you back on the couch if that's okay before we implement. Thanks again everyone for linking in, and we look forward to bringing more to you soon. Take care.